Well, the biggest thing like raising capital is to start now. Don't wait until you need money. And there's several reasons for that. Is one, relationship sometimes takes a little while, and you really want to build relationships with brokers. As much as the local banks might be a nice source, brokers are much better because they have access to a wider variety of lenders on the back end.
Yo, what is up, everybody? My name is Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast, the show to listen or watch if you are an experienced real estate investor, maybe own a couple duplexes. They're kind of paying you chump change, not leading you in the direction you want to live life on your terms. I am psyched out of my mind today because I actually have a guest who, where I have actually two disciples on my show, Mr. Jonathan and Paula Nichols, Jedi Knights in their own right. And I am bringing on like the Yoda or maybe the Obi-Wan Kenobi Jedi Master onto the show. So I have Mr. Michael Blanc on. A little bit about Michael is he's a real estate investor, bestseller author of Financial Freedom with Real Estate Investing, speaker, and leading authority on apartment investing. As the CEO of Nighthawk Equity, host of the Financial Freedom with Real Estate Investing podcast, and columnist, Blank's passionate about helping people become financially free in 1 to 3 years by investing in apartment building deals and raising money. Through his real estate company, Nighthawk Equity, he controls $300 million in multifamily real estate. In addition to his own investing activities, he's helped investors purchase over 40,000 units valued at $1.9 billion. Michael, thanks for coming on the show.
What's going on, Matt?
All right, first question, man's a doozy. You were born and now you're here. What happened in between?
Boy, all right, make it easy. And what's the purpose of life? Okay, so I grew up kind of in a middle class home and kind of follow the recipe, get good grades and get a good job. So I got a master's degree in computer science. I'm highly educated, and at college was basically a programmer. Worked at AOL for a couple of years, and landed at a company in the late '90s, '97 called webMethods. I was in the right place at the right time. I was the third employee. That company blew up, and 3 years later we went public. So I was a millionaire, well, at least on paper, by the time I was 30, which is kind of cool. And then, all the fun people started leaving for other startups, and I was the only idiot that was still there. And it actually started feeling a little bit more like a job, like a corporate job with literally cubicles and things of that nature. And so they went public in March of 2000, and then about 2004, I was starting to get like hopeless about my outlook for the job. And that's when I picked up Rich Dad Poor Dad in 2005. And it appeared to be my ticket out. And it threw me for a loop because I thought I was pretty smart, without everything, especially money. And so what I learned is it doesn't matter how much money you have with your brokerage account or whatever. It matters how much passive income you had. And I had very, very little. And so, I stewed on it for about 3 months, and then finally came home to my wife and declared I quit my job. And she goes, "Well, that's great, Michael. What's the plan?" I said, "I'm not sure yet, but I want me some financial freedom." That was what I wanted. So I basically started learning all about money, and I flipped the house, of course, for good measure. I learned how to trade stocks and options. I took a commercial real estate investing course, but my big idea was restaurants, obviously, right? Because Kiyosaki talks about a cash flow business, and I was surrounded by a bunch of franchisees who were printing money. And I surely wanted to print money. So I hired a guy, I bought a franchise, and I went all in. I went all in. There was nothing left over. And it went well for a couple of years until the recession hit. And then things stopped going so well because the revenue went down and never recovered. And it was this downward spiral. And all of a sudden now I'm losing money. Now I got to let my guy go. Now I'm running 6 restaurants. And so I'm losing my shirt and I needed income. So I remembered I flipped a couple of houses back in 2006 and 7, right before the recession. And I decided to flip my way out of my troubles. And so I started borrowing money from hard money lenders. We flipped about 3 dozen houses. And so I'm losing my shirt on the restaurants and I'm flipping my houses. I was working 80 hours a week and breaking even. It was awful. And then in 2011, I got a 12 unit from one of my wholesalers. And I was like, yeah, I had taken this commercial real estate course in 2006 and I had dusted it off a little bit. And I looked at it. And I was completely wigged out. It was a 12 unit in Washington, D.C. And it was a nightmare in its own right because I just walked in like an idiot without much forethought. And I had no advisors, no teams around me. I had what's called a professional tenant in there who wasn't not just paying rent, but was suing me every 6 weeks. And I was getting fined. I'm running out of money, until 18 months later, I finally calmed it down, replaced the property. I hired a wrong property management company. And then it started sending me mailbox money. And then it got really boring as I'm flipping my way, out of this thing. And then one day I woke up, I don't know, and I was like, man, what, look at this mailbox money and how boring this thing is. Why don't I just do more of that and less of this? And that's kind of when the light bulb really went off. And I was like, man, what am I doing here? This is not passive income. It's too much work. And that's kind of when I started pivoting it. And in 2014, I started blogging about it on the Bigger Pockets of my own site, and people were asking me questions. So I developed an analyzer, I developed a course. And so today my platform really is financial freedom with real estate. So if you want to become financially free with real estate, there's really only one way to do it. And it's not with single family rentals and with flips, because I've tried, many people have tried. So here we go.
Yeah, I am one of the few insane psychopaths that went about it the small multifamily way. It took me 11 years, 25 properties, 76 doors to replace my income. And then I was like, okay, I started this journey when I was single, right? I wasn't married. And I was looking over my wife, my number one life partner, that I wanted to go backpacking through Europe for 2 months at a time. And she was stuck in a classroom teaching high school math. And I was like, oh my God, I got to do this all over again. And that was when the singular moment where I was like, I knew I wanted to do bigger deals right from the get go. And so that was like, the really the fire behind me making that transition. But scaling it while working at W-2, the small, single family, multifamily way is like, you run into the scale dilemma because you're like balancing all of these things. And it's like, really, you don't have to go about it that way. So Michael, let's jump into our case study deal for the day. It was like the first deal that was big for you at the time, and the one that you really learned the most about, best practices and how you've applied it going forward. What do you got for us today?
Well, I think the first deal was probably the most memorable. I think more things went wrong with that deal than probably all of my deals since then combined. And I immediately regretted getting into that deal because it was far more stressful than it needed to be. And I think fundamentally, and this is a big shift from a single family house investing mindset, is that you can't just take a single family house investing mindset into multifamily. Or at least you shouldn't. Or at least I tried about really everything. And I think if I were to boil it down into one thing, there's a book by Dan Sullivan called Who Not How. And when I read it, 3 or 4 years ago, but it kind of articulated in my mind that main difference, right? So typically as investors, we're always asking how questions, right? How do I buy right? How do I estimate? How do I get the ARV right? How do I do this? How do I do that? And Dan Sullivan argues a stupid question. It's the wrong question to answer. Instead of asking a bunch of how questions, why don't you start asking who questions? And when you get into something like commercial real estate, things get a little more complicated. There's a lot more hows to figure out. And so a lot of people just kind of become overwhelmed by the idea and don't even start because of this fact. And it is partially true that it's difficult to figure out the how, but the thing is, you don't need to do it. So when I went in there, I figured out a bunch of things, such as, for example, how do I buy this building? Where do I get the money from? And I didn't really think through who can help me do these things. And one of the missing pieces for me was, and it wasn't a matter of money, I didn't have an advisor. Why don't I have someone more experienced on the team? Right? That single person. And now, of course, I have mentors for almost everything, right? Because why learn on the job? Why make a bunch of expensive mistakes when someone else has already done it? And yes, we're all going to make mistakes. We learn from them, but you don't want to have these catastrophic mistakes or mistakes where you lose years and hundreds of thousands of dollars. I mean, that's stupid, right? And so this advisor would have probably told me never to invest in DC in the first place. Now, why is that? Because DC is very pro-tenant, kind of like New York and California is. I didn't really know that. Yeah, I have happy years on. I get this deal from a wholesaler. I get in there and it's a freaking nightmare. I mean, anyone can go in DC, go to the clerk, fill out a form that's about this big, it's tiny, fill everything, and then the district will package it all up in triplicate and whatever, overnight it to you, and now you have a lawsuit in your hand. And so I didn't know that. Number two, I put the wrong property manager in there. This was a traditional property manager. What I had was a Section 8 building, subsidized housing. Well, he didn't know how to deal with it. Didn't know how to deal with the inspectors, right? So that was a major mistake. I didn't know how to do diligence properly. Otherwise, I probably would have discovered the fact I had a professional tenant in there, someone who had been suing the previous owner for years, and probably the major reason she was selling the house, right? Did I notice that? No, I didn't notice that either. And so, the biggest thing is this who, not how thing. Who's on your team, right? And the big missing member on my team was the senior advisor. But I didn't really have the right I didn't have the right proper manager on the team either. I didn't have the right lender on there because that lender, literally a week before closing, basically reneged on the deal. It was a local bank, right? And so I had to scramble because I didn't have the right lender on the team either. So what I'm saying is there's a lot of lessons there. To me, the biggest thing is if you want to scale, we've got to start using a who, not how mentality.
Excellent, Michael. So let's pull on some threads here because like there's the three components, right? There's the knowledge component, there's the deal flow component, and then there's the capital component to this thing. Let's talk about the deal flow because I've actually gotten some of the best deals in my life from wholesalers. How did you actually get in a position to be top of mind with this wholesaler to get this opportunity in the first place?
Yeah, I don't know exactly. It's not like I was talking about my apartment building investing. I'd spent about 6 months in 2006 calling on brokers, so I cut my teeth on that a little bit. But I don't know if they really knew that. It was just I was buying houses from a lot of wholesalers. So I think he just said, "Hey, I've been interested." And I was like, "Well, maybe I do, right?" But to me, it wasn't really a strategy, and that's the thing. It wasn't really part of a strategy. I was still flipping houses in my mind. It just kind of came along, and I was a bit opportunistic. And so even after I did that one deal, I didn't feel like I could do it again because it really wasn't part of a strategy, right? So I think that's probably the biggest difference. And again, single family house investing, speaking of strategy, you're not finding apartments on the MLS or even on LoopNet, right? So I didn't know that. So I lost all this time trying to find deals. I even sent in 2007, even sent the yellow letters to property owners, right? And that worked with the houses, didn't work for this at all. I was like, gosh, what is wrong with this thing, right? Now today we know that we get deals by building relationship with brokers, and so that took me while to figure out.
Now, so going forward, because I mean, I know I've done a lot of things in my life, in my business that are like sort of like, like guerrilla tactics, right? I have no idea what I'm doing. I don't have a strategy. So what is like your really like nitty gritty tactical strategy to really priming your deal flow going forward so you're getting in front of good opportunities?
Yeah, the biggest thing is, and again, I'm going back to mistakes I made. So we learned from my mistakes, not what I actually did after a while. And one of the things we call now is one of the things I did not do or appreciate is it's what I call deal ready. Actually becoming ready to do a deal, becoming ready to talk to investors, become ready to talk to brokers. I would call brokers up in 2007. And I say, "Hey, I got two flips here, and did a rental. Can you send me some deals?" And they said, "Well, that's cool. How many apartments buildings have you done?" "Well, none, but look at my real estate investing." And they're like, "Well, I'll tell you what. You send me your proof of funds, and I'll send you some deals." I'm like, "I don't have any proof of funds." So I was stuck. And so now we know today that you got to become deal ready, first of all, by using the right language. Number one. So it requires a little bit of education, maybe some scripts or whatever. But most importantly, if you don't have an apartment investing track record, how are people going to take you seriously if you don't have that? And the answer is, again, who, not how. You got to build a team, right? So from a deal flow perspective, and this doesn't take a long time, recruit a team around you, right? Imagine I called those same brokers and I recruited a property manager and lender, for example. I could have called up the broker and before he even says what your track record is, "Hey, I'm working with Sam at XYZ. They manage 5,000 units in and around Dallas, and I work with Bill, and they originated $1 billion of loans last year, and we're looking at deals around XYZ." And now the whole thing about track record never even comes up because clearly I must be a serious person if I've attracted such a serious team around me. And so people who become deal ready in this way will build a team. They're taken seriously by brokers and by investors. They don't struggle with this like I did.
Mm-hmm. Yeah, totally true. I mean, that's the one thing is like I have never gotten asked by a broker for proof of funds on deal on deals I looked at, but that's not the case. Like it's almost like asking for the proof of funds is almost like a hey, it's like an fu kind of thing. Don't waste my time. Um, so on the subject of the capital, right? There's a capital stack to this thing. How'd you go about putting this deal together from an equity and debt standpoint?
Well, again, don't ask me what I did, right? It's more like what have I figured out since then. Um, I kind of, bumbled my way through to get this deal now, and now I got to go find this money. And so that's, if you have a deal under contract, it's very difficult slash stressful to now start raising money. There's not enough time. So today we raise money long before we start making offers through something called a sample deal package. Sample deal package is an investor package on a real deal with real photos and financials, but you don't have it under contract. Now, you tell your investors this, but it's a conversation piece, therefore allowing you to have a conversation with an investor right now so that you get a soft commitment. And they ask questions about you. Why multifamily? What's your team? They ask questions about the deal. How's it structured? What are the returns? They ask all these questions. And then by the time you're done, you're like, okay, obviously, as I told you, it's not a real deal, but when I get one that looks substantially like it, I'll let you look at it. Right now, 2 months go by, 3 months go by, you get a live deal, you're staying in touch with them. Now you send them the real deal package. It looks substantially the same as the sample deal package. And now the questions are very minimal. And so therefore you can now raise money very quickly. And you have a lot of confidence behind you. If you have 5 people who give you a soft commit of 50,000 each, if you had $250,000 in soft commits, would you feel somewhat, at least, somewhat more comfortable and confident making an offer in $1 million building? Well, the answer is yes. Now, you still might lose a one or two in the process, but you have a lot of confidence in it built up. And so now that's how you go about raising money. You raise it now long before you actually need it.
The conversation piece. So it's like we should put together like a coffee table book and put put it at our house someplace when we have parties, right? So on the debt sourcing, right? So what are your tips and advice and at what point in time should those conversations start with lenders? Because on all of our deals we have our debt, we have our equity. I mean, sometimes we have deals that are so distressed that we've bought and taken down that no bank would touch it. Actually, like the building I'm sitting in right now, it was 50% occupied, and all the commercial tenants were on month-to-month leases, for instance. So, but most of the deals that I've done, there's a blend of both. So, what are some actionable types of things that people can do to start sourcing the right debt for those deals they're going to do in the future?
Well, the biggest thing like raising capital is to start now. Don't wait until you need money. And there's several reasons for that. One, relationships sometimes takes a little while, and you really want to build relationships with brokers. As much as the local banks might be a nice source, brokers are much better because they have access to a wider variety of lenders on the back end. So not just of the same type, like a Fannie or Freddie type lender, but also bridge loans, for example, or construction loans, or HUD loans, or student loans and Section 8 loans, okay? And so you might need more than one broker to get a coverage for that. So now you have a gamut of different products based on what you're seeing. And it's very important as you're underwriting deals also. Well, what interest rate should you use? What loan to value should you use? What are you getting? What are your net worth and liquidity requirements, right? How many years of IO? If you need to put that in your underwriting, otherwise you're just going to be shooting in the dark. So you need your lender on board, number one, to build credibility, and number two, to underwrite deals. And then when push comes to shove, you can now ask your brokers to give you these various term sheets, and you get them side by side. You might get, various 2 or 3 different products of the same side, and now you can choose which one is the best one. And so start early, build relationships, understand what their requirements are, what their loans look like.
Not all brokers are created equal. So what is the best methodology for finding your best-in-class mortgage broker to get on your team?
Well, it comes with networking, right? I mean, yes, you do the best that you can. I think at a minimal, you want more than one broker on your team. So for this particular reason, but oftentimes the debt makes all the difference. Like even if the interest rate is 0.5% more, or you get 5% more leverage, now all of a sudden you can pay more than the competition, or you can make more for your returns. So not all lenders are in fact created equal. We have actually had lenders not just have access because they do more loan volume, they get better terms, but we actually have gotten better terms simply for the relationship. For example, hey, I'm gonna give you a break on this thing here, but you know what? I want your next at least 2 deals, that kind of thing. And so he who has the best debt wins. And so for a period of time, we were even networking with credit unions because some of their terms were actually better. There were less owners to work with, things of that nature. So it helps to really, whoever's in charge of the debt, to really continuously network, especially as markets change. Having a large lending network is really beneficial.
Yeah, to add on that too, I mean, shout out to our broker, Tom Gravinsky of Gantry, because the one thing as well that is really important, at least to me, is that the broker is also known amongst the commercial brokerage community. And, Tom, one of the reasons why I love him is that He's at all the industry events. He knows all of the brokers, so that when you have a deal with a term sheet you're presenting to a broker, it just really, really adds that credibility factor to you. So I love it. But Michael, you're breaking my heart a little bit because we've loved working with community banks and local credit unions, and mortgage brokers have sort of been like our lender of last resort in the past. So challenge me on that.
No, not at all. No. I think we've done at least a couple deals with community banks. I think what I'm saying is have a large repertoire and option available that gives you the best choices. I think credit unions are a fantastic option. They're not always the best for all situations, but it's better having them in your arsenal than not, right? So we looked at HUD loans before. They very rarely work, but if they could work, they'd be amazing. Just the amortization and things of that nature. So yeah, the wider of a network you have in a lending environment, it's worth what I'm saying. It's worth building out your network with lenders.
So let's talk about your operational framework and how you implement it. Because I'm assuming you've been doing this for long enough, and you've been instructing your clients as to framework to use on developing the business plan as well as executing it. Can you give me some flavor on what that looks like?
So how do we execute and plan the business, that kind of stuff?
Yeah, correct. Mm-hmm.
Yeah, so we use something called EOS. I don't know if you're familiar with that, Enterprise
Yeah,
Operating.
traction. Yeah, traction.
Traction, yeah, that's something we've been kind of using that for about maybe 3.5 years or so. And it's simple enough, but it really has transformed the way that we plan, hold each other accountable, how we conduct meetings. So it's been pretty cool. And the cool thing with it is you can use it for a very small team. You don't need a giant company for it to be meaningful. You can even do it yourself to hold yourself accountable. So it's been a game changer for us.
Yeah. So generally speaking, now, one of the things you've said in a lot of your content on social media, and by the way, follow Michael. He's got amazing content. I've actually been following Michael for many, many years now. You've been talking about smaller deals, all right, and the advantages of doing smaller deals. So kind of walk me through that, because back, not back in the day, but back a few years ago, as everybody was 250 units are up. If it's less than that, then we're not interested. So, challenge that assumption on there, because a lot of people think that oh, you got to do a 100 unit plus deal for your first commercial.
Now obviously that would be great to do 250 unit deals all day long, but really, so especially when you're doing your first deal, you want to pick a deal that is number one, meaningful to you and achievable within the next 12 months. For example, if you're making $10,000 a month, you going out buying a duplex is very achievable, but not very meaningful. You need a whole bunch of duplexes. Yeah. Versus if you're making $4,000 a month and you go after 100 plus unit, well, it's very meaningful, but not very achievable. So we gotta pick something that's kind of in between the two. Now the good news is there's this thing called the law of the first deal that I write about all the time, which says that as soon as you close your first multifamily deal, you're literally 1 to 2 years away from financial freedom, which is proven to be true. And it doesn't really matter what size it is. Even if you go out and you buy a duplex with a multifamily mindset, once you do a duplex, you're not doing another duplex. You're probably doing a 5 unit, and then you're doing a 10 unit, then you're doing a 20 unit. They get progressively larger, which is why they're powerful, right? And so if someone can't wrap their head around buying a $4 million property, yes, then by all means, then start with a duplex. As long as you start and you have a scaling mindset, you're going to get there.
Now, Michael, under one sheet, I would be remiss without asking this question: how to raise your first $1 million to scale with multifamily real estate. Capital raising is a really, really scary thing for those people that have kind of bootstrapped their entire way with using their own cash, using hard money lenders, using the Burr method, credit cards, and that sort of thing. So I guess what is the framework and really process for starting with to build your OPM?
Yeah, so again, it's a bit of a who, not how kind of mentality, right? So now we're asking the question, how do I raise money? It's not a bad question, but if we ask ourselves the question, who can help me get access to money, it changes things. So for example, in multifamily syndication specifically, joint venturing is very common. I'd say almost the vast majority of certainly students in our ecosystem are joint venturing with each other. And that is because there's two main roles in a syndication. There's a deal finder and the capital raiser. And right now we're talking more about the deal finder. The deal finder has access to deal flow, but struggles raising with capital. But for every deal finder, there's one capital raiser, and they struggle in a similar way. These are high net worth individuals with access to capital, but they don't really like spreadsheets, or they don't want to certainly spend the time underwriting deals and talking to brokers and things of that nature. And so what they wanted, they're looking for deal flow. Their biggest problem is deal flow. And with the who, not how mentality, every deal finder should learn how to raise capital. And it's actually not nearly as difficult as it is. You don't actually have to beg people. You don't have to learn some kind of ninja mindset manipulation tactics. Every deal finder should still learn how to raise capital. But the answer to your question, how do you raise your first $1 million, is you actually partner. There are people with access to capital. So if you're a deal finder, you have something very valuable to someone who has access to $1 million, and that is a deal. So if that's you right now, yes, by all means, raise $100,000, raise $200,000, but spend your time networking to find this capital raiser or capital raisers, because now you can bring in a $4 million deal that you have access to, and now you have a capital raiser who has access to $1 million, and that's how both of you do a $4 million deal.
So networking. What about not working? All right, because there's a lot of people that network to not work. What is your? How do you network? Like, let's get a little bit tactical here, because a lot of people don't really intentionally or strategically do it.
Yeah, that's true. I remember I had a couple on the podcast. Two Americans lived in the UK for work. I've been there for a while, and they started doing a series of deals from the UK, and it was all through networking. And I was like, "How did you do it?" And this was like after COVID, right? So everybody's online, of course, and so, but it's actually very simple. And actually, the same thing works for in-person conferences. This hardly anybody does it. What happens normally when you're in a conference, right? You get someone, and they move up to you and immediately give them they give you your business card, and they either want something or they're selling you something, right? So what's your impression of that person? Ugh, like, it's negative, right? But if they're kind of cool by the pool, and you're having a good conversation, and nothing ever comes up, no agenda whatsoever comes up, now you have a positive impression of that person. So why not follow up after the conference, right? Hey, I remember with so and so. And oh yeah, great. Yeah, let's just do a Zoom call, catch up, get to know each other. Yeah, of course you're going to say yes. You're going to get a lot more done in that 30-minute Zoom call than you can at any conference, unless you're at the bar. Of course, that's a different story. But also in Zoom calls, there's so many people get on these Zoom calls, right? Why not reach out to everybody privately saying, hey, I'd love to connect with you. Here's my email and my phone. Would love to connect with you, right? And now you're collecting addresses. And this is what this couple did. They just hopped on all these Zoom calls, collected all these numbers, followed up with every single person. And they started building this amazing network of capital raisers, KPs, deal finders, property managers, on the boots on the ground partners, right? And that's how they did it. And why are we not all doing that? And that's really how we network. And if you know that you're more of a deal finder, now you kind of know who you need on your team, right? If you're a deal finder, don't partner with another deal finder. That makes no sense, right? Look for capital raisers or KPs or something that you need on the team. Now you can be a little more intentional. Or at the same time, you could build a little mini mastermind of deal finders, right? If there's other deal finders like you might not need anything. Why don't you create a group of 5 people together, and you meet every week or every other week, and you're like providing each other support. So what I'm saying is network with intention.
Michael, last question before we get into our parting words of advice and how our listeners can learn more about you. But social media, I mean, you're not doing it for fun. I'm not doing it for fun. So really, what is the purpose behind your social media platform, and why it's important for other people that are looking to scale into multifamily commercial real estate?
Well, you just said it. If you're looking to scale, right? If you're just starting out, to me, it's kind of an ego thing. Like, honestly, because what you're really trying to do is you're trying to learn, for example, how to raise money one-on-one. So you know what to say, what your investors want, what they're afraid of, right? Because a lot of people think I'm just going to go on social media and people are going to wire me money. That doesn't work. Like, you need to know your message. How can you amplify something you don't even know what the message is? It makes no sense. Now, when you're scaling, though, and when you've raised $500,000 or $1 million and you want to 10x that, you do need to get the conversation online, because there's not enough one-on-one meetings you can have. At that point, though, you kind of know what your ideal investor, what your avatar is. You kind of know what your platform and your message is, and you can start amplifying that and going out with that. But at that point, though, it's not just social media, and it's not just your website, right? You need like a lead magnet and a form. You need automations on the back end. You need automations that set calls. You need to be able to now commit to weekly content, so you can indoctrinate the people on your list, stay in touch with them, build trust, so that when you actually have a live webinar, you can raise millions in days. So It's definitely a phase one, phase two. If you're scaling, then yes, you're going to spend a lot more time online, but it's not just social media. It's all of everything I just mentioned.
Yeah, I mean, the first time it actually like where a light bulb went off was, and the first person that told me to, because I used to just like do a lot of stupid stuff on social media, like in terms of like like memes before they were even called memes, and I got on a call with Joe Fairless, and he was like, you need a platform," and so I started doing that, like posting content, that sort of thing. And I did this for about 6 or 7 years. And the light bulb really went off in my head when I was walking on the canal with my wife. And this guy started yelling at me out in the distance. He's like, Matt, Matt. So I turn around, and it's this guy that I hadn't even thought of in 8 years. And it was like, hey, I love everything you're doing. And he's never liked or commented or shared anything I've ever done. But at that moment, I was like, this is how I can actually have like highly leveraged one-on-one conversations with people when it's time to, let's say, present an opportunity or even work together across multiple facets of my business. So, I mean, that's the reason why I'm like so maniacal about it. And I think that the more you do it as well, the easier it gets. Cause at first it's like incredibly awkward. I don't know. What are your thoughts?
Yeah, absolutely. I mean, we've taught people how to build platforms. People who want to scale, and they don't like the way they look on video. They don't like the way they sound on podcasts, and they're not good writers. And it is a lot of work. And so my advice to you is you should outsource the production and distribution of content as soon as possible. It costs money, but you should never outsource the creation. Just figure out what your best way to create is. Some people just like to riff into a video. Okay. And if you can create blog posts and emails and shorts from that video. Or some people like to write more. Okay. Then create scripts from that and then create the video from that. Or some people just like to talk into their microphone. Right. So figure out what is your outlet, and then you create that with your voice. And then ideally, as soon as you're able to, then you do want to hire some VAs that produce this content, because that gets a little tedious. It's not the best use of your time.
Excellent. So parting words of advice. I mean, our listeners that are out there own a duplex, right? They know they need to scale into doing larger commercial multifamily deals in order to position themselves to be able to live life on their terms and walk from their W-2. What types of things can they do today, this week, this month to start orienting themselves in the right direction?
Yeah, the first one is awareness. Like you said, if you know that you can't get there from here, then what are you going to do, right? I know we talk about commercial real estate and apartments all the time, and people, they say, well, yeah, but it's a very advanced strategy. Let me do this for another 5 or 10 years, get that experience and the money I make, and I will then slowly graduate into apartments. And the good news is you don't need to do that. I mean, you can if you want, but you can literally stop what you're doing, get right into apartments right now. So we talked about building a team around you, using a who and how mentality, raising money, joint venturing, things that there's ways you can get in this business and scale very quickly. So you don't need 5 or 10 years of flipping or 5 or 10 years of renting. So it's simply just having an open mind, and maybe considering that you might have some false beliefs about apartments, or even some limiting beliefs around that. And what can you do about that? So one of the best things we for this exact reason, we have a training on how to go from single family house to multifamily. It's called Apartments 101. Just go to apartments101.co. And it's just a 45-minute training video that speaks exactly to people with rentals and flips who can't scale, and they're a little bit scared getting into the apartment space. So that might be a great thing for people to check out next.
Yeah, we'll definitely put the link to that resource in the show notes, Michael. Outside of that, how do our listeners learn more about you and what you got going on and how to get into your ecosystem?
Yeah, apartments101.co is a great entryway in there. And you can just Google my name, Michael Blank, Blank, and you should be able to find everything. We're on YouTube. We have podcasts, and we have a book on Amazon called Financial Freedom with Real Estate Investing. So it should be fairly easy to find. We have a lot of free resources, and just to get people more familiar with the space.
Excellent. Michael, thank you so much for being generous with your time, and I look forward to talking to you in the green room.
Thanks so much.